Welcome back, ladies and gentlemen, to the A-Star Investor Mentorship. In this video, I want to teach you the concept of time frames. Now, if you pay close attention to the top left corner of your screen, you will see price quoted on this top left box. You see Chewy Incorporated. You see 1W. So that 1W stands for 1 week. So we are looking at the weekly time frame. So the weekly time frame just means that each candle bar, as seen on this chart, represents 1 week's worth of trading action, 1 week's worth of price action, meaning that where each candle opens and closes, and the difference between the close and the open of that candle in terms of time duration is 1 week. Now, of course, the market is fractal. Okay, so understand that the market is fractal. What that means is that what is occurring on the weekly time frame is also occurring on the monthly time frame. It is also occurring on the daily time frame. It is also occurring on the 2-hour time frame. It is also occurring on the 15, the 5-minute, 3-minute, and the 1-minute time frame. Price action is the same on every single time frame. So you're now wondering, so same world, like what's the difference between each time frame? Then if you're saying that time, like what are you talking about? My head is about to explode. Well, what I mean is what I mean. Price action is the same on every time frame. As you drop down in time frame, price action only becomes more detailed. But it's still the same price action. So imagine I came into the market and I want to purchase a stock. And for example, this Chewy stock, hypothetically speaking, Chewy has 10 million outstanding shares, meaning that in the whole entire circulation, there are only 10 million shares of Chewy. Now, if I came and said I wanted to buy 3 million shares of Chewy, that is going to impact the price of Chewy because there aren't that many shares. Okay? So if I come in and do that, I don't care what time frame it is, I'm just going to hit the buy button, right? I'm going to just start slamming the buy button to get my orders filled. And that action is going to be reflected on the 1-minute time frame. It is also going to be reflected on the daily time frame and on the weekly time frame and all the other time frames because price action is live data. So now you understand that when you look at time frames, it is all the same thing except price action becomes more detailed as you drop down in price. So when you want to take a setup, when you want to place a trade, if you're looking at the 1 week time frame, for an entry on your trade, it is important that you also use the 1 week time frame to determine how much you're willing to risk. The time frame that you analyze your setups should be the time frame you also use to define your risk level. Now, you already understand by this time that the participants behind price action are the BFGs, the big financial groups. Now, it's important that you know what time frames the banks use to set their own trading plans. Okay? So the banks use the monthly time frame. The banks also use the weekly time frame. And the banks use the daily time frame. Okay? So none of that lesser time frame bullshit, none of that 3-minute trading bullshit. The banks set their prices on the monthly time frame, the weekly time frame, and the daily. Okay? So the monthly time frame is positional traders. Positional traders, you hold positions for years on end, a year, 2 years, 3 years, 5 years. They use the higher time frames to give them a large outlook on the market. Okay? So they set their price action, they set their trading plans on the higher time frames, and they target the liquidity pools on the higher time frames. So these position traders who want to invest long term, they put the most amount of money into the market. A candle that forms over 1 month is going to have a lot more volume and a lot more money inside of it than a candle that forms in 5 minutes. Likewise, a trend that forms in 1 month is going to a trend that forms on the monthly time frame is going to be stronger than a trend that forms on the 5 minute time frame. So there's more money on the higher time frames, and the amount of money that there is on the chart drops as you drop in time frame. So there's the most amount of money injected by institutions is seen on the monthly chart, then the weekly, then the daily, then the 15 minute, then the 4 hour, 2 hour, 1 hour, 15 minute, like progressively downwards. That's how it moves. And what do I mean by that? You see that when price reaches a liquidity pool on the monthly time frame, the reaction away from that area gives you trades that last for months. But when price reacts off of a liquidity area on the 5 minutes, it's going to give you a much shorter trade. Reason being that more money is being injected on the higher time frame. Okay? So now right here, this is the monthly time frame of this Chewy stock. And we want to consider this price region. Right? Now look at this down move on the monthly chart. Look at the top and look at the bottom. If you look at it on a weekly chart, when we drop down, it is still a downwards move, except it is more detailed. It is still the exact same downwards move. Look at it on the monthly. You notice that there were lesser bars. And then look at that same move on the weekly. See how from the top to the bottom, same distance, same everything, except the trend is now more detailed. Now look at those same bars on the daily chart. Oh, now you see that there's a whole lot more candles on the daily chart. This is the exact same move you saw on the monthly. Look at it on the daily. Now if you go to the 2 hour, just like the daily, same down move. Now go to the 15 minute. Now this is the 15 minute time frame. And we can't even fit the entirety of the box because there's so much price action. You know? So the point is this. When you want to analyze the chart from top-down analysis, you want to start on the monthly time frame. Okay? You start on the monthly time frame. The monthly time frame has the most amount of liquidity, most amount of money, and the institutions set that the banks and institutions set their price levels on the monthly time frame. Price is always moving towards liquidity pools on the monthly time frame. Every time you trade, zoom out of that time frame and look at the monthly, and you will see that price is always moving to a liquidity pool on the monthly time frame, and it's always moving away from some liquidity pool on the monthly time frame. Okay? So from there, you drop to the weekly, and the weekly will give you a more detailed version of what the monthly is trying to do. Okay? So when you look at the liquidity pools on your monthly chart, when you find where the money is sitting on your monthly chart, then you want to go down to your weekly, and the weekly will show you a more detailed version of how price is trying to get there. Okay? And then when you find that, you now understand, you know the magnets essentially are those liquidity pools, and price is trying to reach for those levels on the weekly chart, on the weekly and the monthly. Then the daily chart is now going to be the bread and butter. Okay? So the daily chart will be a detailed image of what is going on the weekly time frame. You got to think about it. In a week, there will be 5 daily candles. So a day is going to give you more detail on what price action on the weekly was doing. Okay, and that's where the game is. So you don't need to know any other time frame for you to make money. Understanding that these 3 time frames is the bread and butter. The monthly chart is where institutions set their levels. Now, a more realistic way of analyzing the monthly chart is on the weekly, because the weekly gives you more detail into the monthly chart. So this is a weekly chart right now, and the weekly chart is still doing the exact same thing the monthly chart is doing. Okay, so say for example, look at these equal lows right here. Price made this high here, made another high here, and they were about the same high. Equal lows, liquidity pool. Now you have a downtrend following it, and now price is reaching up. Price is going to want to go and fill that area. Sellers sold that high, so there's going to be buy stops above that place. You know that new sellers can pair with those buy stops, so price is going to get delivered up to that high. Market. Okay, so we know that on the weekly time frame. Now, what can we get from the daily? The daily is going to show us a more detailed version of the move, of where we are right now. And then once you have that, now when it comes to the hours, you want to understand that the daily, the monthly, and the weekly, those are the higher time frames. Now take this, put this in your notes. The interim time frames are the 4 hour, the 2 hour, the 1 hour, and the 15 minute. So a 2 hour, 4 hour, and a 1 hour is going to show you exactly what the daily chart is doing, except in greater detail. Okay? So when you take a daily chart, you put it down to the 2 hour, it is the exact same thing. So when you take the daily chart, see how on the daily chart we had this high, we had a low here, and we had another high up here. When you put down a 2 hour, it is the exact same thing, except now in greater detail. Okay? And then the 15 minutes is the real bloodline of the chart. So the 15 minutes shows you exactly what the chart is doing. Okay? So the banks set their levels on the daily chart. You know that the daily chart is moving towards weekly and monthly liquidity pools. You know that the 2 hour and the 4 hour and the 1 hour, the interim time frames, they are going to give you a more detailed picture of the daily chart. They don't change the picture, they just give you a more detailed picture of the swings on the daily chart. And then the 15 minutes is really where the market is moving. So if you're trying to day trade, the 15 minutes is what you should pay attention to. That is where you should find your setups. The 15 minutes will show you how price is moving from one side of the market, a discount side, to a premium side. And you'll be able to get in and out of those trades. And then the lesser time frames, which are the 5 minute, the 3 minute, the 2 minute, the 1 minute, those are your entry time frames. Okay? Those are your entry time frames. So peradventure you decide to scalp or day trade, then you want to be in and out of the market with precision. Advantages of trading one time frame over the other. If you want to be a long-term trader, a swing trader, or a position trader, you want to look at the monthly time frame, you want to look at the weekly time frame, you want to use the daily time frame to put on your trades. Now, if you're a long-term trader, you're going to make a lot of money in terms of the distance of price moves. So say that you sold this high for any reason, you can have price moves of 120 all the way to 22. You see, you can have price moves of 97 bars. That's a big trade on Chewy for a stock, right? But the problem with The downside to, or should I say, not the downside, the trade-off of having a lot of points in terms of distance of trades is that swing trades will take a lot of time. So if you're the type of trader who doesn't have the patience to sit through his ideas or trade, and you get easily shaken, then maybe long-term trading isn't for you. So this trade would have taken off in February 2021 on the 16th, and you would have held it till the end of May 23. So that would have been what, February, March, April, May, 4 months in a trade. Now, the other way of looking at the market is now from a day trader's perspective. If you want a day trade, you can use the daily chart, you can use the weekly chart, and you can use the hourly chart as well. Now, alternatively, you can be a day trader and trade the 15-minute. You can be a day trader and trade the 15-minute and the hourly chart. And when you do that, you can catch good swings that do not take a lot of time. And you got to understand that price action is the exact same thing on all time frames. So if you have a strategy that works and it's easily identifiable that you see on the weekly time frame, you can also use that same strategy on the 15-minute time frame. You can also use it on the 5-minute time frame, because all price patterns occur in every single time frame. You just have to adjust. Okay, and when I say that there's more potential for larger trades when you trade on the weekly time frame compared to when you trade on the lesser time frames, I want to show you guys this rule personally, because I feel like if I had recorded this for myself, and mind you, I'm not doing this mentorship for, respectfully, you that is watching this right now. I'm doing this for my younger self, the young 16, 17-year-old SW who started in the crypto markets but was lost for many years without proper guidance. So to fulfill all righteousness for that little boy, that is why I'm doing this. I wanted to make this point. When you look at the weekly time frame, let's observe the most recent weekly time frame candle. This candle right here. Okay? See this candle, this last one. You can see the one I'm talking about, right? This bad boy in the middle. That's what we're looking at. Now, if you're a weekly time frame trader, you probably bought this low. But I want to pay attention. I want to bring your attention to the range of this candle. Do you see that the low of this candle is 36.35 and the high of this candle is 41.71? So the low of this candle is 36.35. The high of this candle is 41.71. That's a 5.35. That's a 5.36 increase in price, right? And if you look at the previous candle, it had an almost $5 increase in price too. If you look at the last up close candle, it had a $6 increase in price. So I want you to pay attention to the range. The range is between $5 and $6. So when you trade on the weekly time frame, just between this high and between this low of this candle, which is 29.83, and the high of this candle, which is 41.47, 41.71, you have all these points. But mind you, this is 1, 2, 3, 4, 5, 6. This is 6 candles. This is 6 weeks of price action. So it will take you 6 weeks to capture this trade. Now, pay close attention to this singular weekly candle I was showing you earlier. And if we open it on the daily time frame, that candle began on Monday the 12th. If you open it on the daily time frame, you can now see price action from Monday the 12th. So Monday the 12th actually started on that day as a down close candle with a lot of range to the downside. Now Tuesday, the next day, Tuesday the 13th, was kind of like a pin bar. Not a pin bar, sorry. Like a doji. Now Tuesday was a down close candle. Wednesday up close, Thursday up close. But my point is, do you see how there are now 4 candles? This is the same 1 week's worth of price action that we're looking at. But on the daily time frame, it is 4 candles. So we can now clearly see where the candle made its low. We can see where the candle made its high. Now look at the range of the daily candles. Look at the last one. The last one opened at 40 with a low at 40.65 and a high at 41.71. Can you see that the range is only $1? Virtually $1. As compared to the range of the weekly that was $6 per candle. The range has shrunk. Now let's go to the 2 hour, right? So we're looking at all the 2 hours candles starting from Monday the 12th. And do you see that now we have way more candles? Now we can now clearly see the low of that weekly candle. We can now clearly see that same low of the daily candle. This is that low on the 2 hour. Do you see how the 2 hour has now created more candles for us to look at, more detail for us to look at? So now remember that weekly candle, this up close candle that we looked at earlier, this candle right here, which was just one big white candle, has now become several up and down close candles, which you can see the trend now, right? So that one single candle, where you saw it and you looked at it and there was just one candle, is now a swing up, push, swing up. You get me? And now here we are. So do you see how that single price action is translating to all these lower time frames? Now let's go to the 15-minute. So the first 15-minute candle from Monday the 12th. And that is actually, now you can see that the low of that weekly candle on the 15 minutes was a big displacement to the downside, which later got filled by price. And now you see how that single white block on the weekly time frame has now been transposed to the 15-minute, and now it is so many candles. And that's how it works. And so if it goes down to the 5-minute, it's even way more. And now you can clearly see. You can now clearly see. Do you see what I'm saying? You can see all the impulse swings by price. You get me? So go back to what I said earlier in the previous video on time frames about how time becomes more detailed and the step from how it goes from the monthly to the weekly to the daily to the hourly. How price becomes more detailed in that manner. And then go and look at your charts and take a single candlestick on your favorite stock or your favorite currency and look at that candlestick from the monthly point of view. Analyze that same time frame. So if you started on Monday, the May 14, look at the May 14 on Monday on that same monthly candle. Look at it on the weekly. Look at it on the daily. Look at that May 14 on the hourly and on the 15 minutes. And you see how it is the same exact price action, except it becomes more clearer and detailed.